Something very unusual is happening in the Australian property market right now. Something you almost never see. All of the major signals that actually matter, price momentum, buyer sentiment, demand, listings, and competition on the ground are now pointing all in the same direction heading into 2026. And that direction, it isn't price stabilization and it's not a soft landing. It's a broad, accelerating upswing. House prices have now risen for 9 straight months, adding another $54,000 to the median Australian home. Buyers who sat out the rate hike period are now coming back. Search activity is rising, competition is tightening, and confidence is quietly returning on the ground. But the most important part of this story is supply, or the lack of it. You see, listings across the capitals remain 15% lower than this time last year. And when improving demand hits a market that's this undersupplied, you don't get slow, steady growth. You get compression, you get urgency, and you get early cycle pressure that feeds on itself. So yes, the setup for 2026 is extremely bullish. But here's what I'm going to be doing in this video. I'm going to walk you through the key forecasts in Domain's brand new 2026 forecast report and give you my real take on what I think they've gotten right, what they've undercooked, and more importantly, the on-the-ground data that completely contradicts parts of their model. And guys, if you stay right until the very end, I'll explain the risk, the nuance, and the principle that keeps you safe even when the market is running hot. Guys, my name's Josh, I'm from DataEdge Property, and I help everyday Australians navigate the Australian property market using data that's accessible to absolutely everyone. And if you get value out of today's video, make sure you hit the like button and subscribe so you can continue receiving data-driven updates just like this. And with that said, let's dive straight into why momentum is building much faster than everyone expected. So when you zoom out and look at the data properly, you can see the early cycle signals forming clearly. Houses are selling faster, vendors are discounting less, buyers are more active, and these behaviors show up at the beginning of an upswing, not towards the end. And importantly, this cycle isn't being led by any particular capital city. In fact, that entire idea of Sydney or Perth leads and everyone else follows, it's just a myth. Markets don't follow cities. They follow supply and demand fundamentals. And right now, the imbalances are strongest where stock is tightest. And as we can see here on this table out from Cotality, which shows us the growth rates across each capital cities across the last month, quarter, and year, Perth remains the clear standout. Monthly house price there is still surging and quarterly growth is above 6%, the strongest anywhere in the country. Brisbane is next, rising nearly 2% monthly and close to 5% quarterly, again far ahead of the national average. Sydney and Melbourne are rising too, both showing meaningful quarterly gains, but at a more measured pace, consistent with larger markets where supply has loosened slightly. Adelaide is also rising quickly, but that's late stage momentum, not early cycle supply imbalance. That's a market running hot despite stretched affordability, not because of tight stock. So the real story is this: momentum is broadening, and that's exactly how national cycles form. It's not one city dragging the rest, it's pressure building across multiple markets simultaneously. And that broadening becomes even clearer when you compare it to the official 2026 forecasts, because some of those forecasts line up perfectly with reality and others, well, they're nowhere near the mark. With that said, let's bring up the Domain house price forecast for 2026. And let's kick off with Sydney. So they're saying for 2026 that Sydney will do a 7% growth year. But the interesting part is this: Sydney's not actually doing what most people think it's doing. Most people assume Sydney is cooling because affordability is stretched, but the live data, it just doesn't support that. Sydney's quarterly run rate already puts it ahead of the 7% annual trajectory that Domain's come out with. Sydney, it isn't a boom and bust market. It compresses and decompresses with borrowing power. With borrowing capacity improving and new listings still soft, Sydney looks more like an 8% market for 2026. The real swing factor, it isn't demand, it's simply how much stock hits early in the year. With that said, let's shift over to Melbourne, and this is the one that most people underestimate, but not for the reasons that you'd think. So Domain's saying that Melbourne will do a 6% year in 2026, and my view is that's a pretty bang on call. Melbourne at 6% is probably one of the more accurate forecasts in this report. The city is finally completing its multi-year recovery. Affordability is significantly better than Sydney, and investor confidence is finally stabilizing. The key insight here is that Melbourne doesn't need a surge in demand to hit that 6% figure. It just needs stability. And right now, that's exactly what Melbourne finally has. It's got strong mid-cycle gains, steady pressure, and a normalizing market. 6%, it probably makes sense. What about Brisbane? Well, Domain's saying 5%, and this is where this report completely loses me. My view is that's wildly undercooked, and I think that it's going to do at least 8 or 9% and potentially quite a bit more than that in 2026. You see, a 5% forecast for Brisbane assumes that the market slows from today's pace, and absolutely nothing in the data supports that right now. At the moment, Brisbane's growth, it isn't speculative, it's structural. Population flows, rental pressure, extremely constrained land supply, and deep owner-occupier demand all points to continued acceleration into 2026. From everything I'm seeing right now, Brisbane's behaving like an 8 to 9% market, not a 5% one. And Domain's model likely misses this because they're built to detect reversion, not structural demand shifts. With that said, let's touch on Adelaide, and Domain's forecasting 4% for 2026. Look, this one's probably going to be pretty close to the mark, but for the wrong reason. Adelaide at 4%, it's probably correct, but not because the market is naturally slowing. It's Adelaide's affordability. It's so stretched at this point that new buyers physically can't stretch further. Mortgage repayments now sit at over 50% of disposable income for new entrants. And that's up massively compared to just 5 years ago. So the growth cap, it isn't demand weakness, it's buyer limits. And the forecast is probably right, but just not for the right reasons. Now let's shift to Perth, and that's where we arrive at the least believable forecast in the entire report. Domain is saying that Perth will do 5% in 2026, and I think that's not even close. Perth doing 5% next year would require a collapse in demand and a flood of new stock, and neither is remotely close to happening. Perth is still the tightest housing market in the entire country. Listings remain near record lows, under 3,000 listings for the entire state, which is about 3 weeks worth of supply. Quarterly house price growth is at 6%, which in and of itself is above their forecast. Rental stress is the worst in the country, and Perth is behaving like a double-digit growth market. And unless something fundamentally changes from here on in, the realistic range is probably closer to 12 to 15% based on what we're seeing on the ground right now. So this is easily the least credible forecast in the report, and it highlights how East Coast centric these modeling systems still are, particularly when it comes to Domain. Lastly, let's touch on Canberra. Domain saying a 5% growth rate in 2026. Look, I think that's probably pretty close to the mark. Canberra, it rarely surprises. It doesn't overshoot during booms. It doesn't crash generally during downturns. It tends to absorb shifts in borrowing power more smoothly than the other capitals, and a 5% year is probably realistic based on the data right now. And guys, if you want to stay ahead of these cycles using real data, not opinions, make sure you jump into my completely free DataEdge Property Facebook community. I post suburb deep dives, charts, and early indicators there before it ever hits YouTube. Links in the description down below if you're interested. Go check it out. And guys, I'd love to hear from you and what you're seeing on the ground. Do these forecasts match the reality where you are, or do they completely miss the mark? Again, let me know your thoughts down below in the comment section. With that said, let's discuss how smart buyers actually take advantage of a boom. They don't just chase them. You see, property booms, they're not one clean, predictable architecture. That's not how Australia works. You've got markets within markets, and they don't all behave the same just because the national headline is up. A boom can be happening on paper whilst individual suburbs remain flat even decline or quietly become time bombs. Whilst yes, the affordable house segments, they often move first as borrowing powers improve and buyers rush in, just like we're seeing in the more affordable pockets of Melbourne right now. And yes, the mid-tier family home belts, they generally heat up next. But after that point, the paths, they diverge massively. Some suburbs surge, some barely move, and some only go up because the rising tide, it masks just how fragile they actually are. And this is why you never want to buy blindly during a boom. You see, there are suburbs that I wouldn't touch, not even with a 10-foot pole, areas with flood risk, flight paths, poor streetscapes, patchy owner-occupier depth, or future oversupply that's already baked in. And then there are the real traps. You got mining towns, single industry towns, and pockets where one employer or one project is holding the entire local economy upright. Those places can look amazing during a boom until the day that they're not. And when the single employer leaves or the project ends, the floor disappears almost instantly. And that's why fundamentals matter much more in rising markets than in falling ones. Scarcity, street quality, land configuration, owner-occupier demand, long-term rental depth. These aren't just nice to have. They're the difference between holding an asset that compounds for a decade and holding an asset that only looks good because the tide is in. Remember, in booming markets, everything goes up, but nothing goes up equally. And if you're not careful, the very houses that look cheap and tempting in a boom are typically the ones that collapse first when momentum fades. And guys, if you want to see the other half of this conversation, the part about what happens when the regulators finally step in, make sure you watch my video about why APRA could be in the process of ending the game for property investors in 2026. It breaks down why intervention is finally back on the table, what APRA is seeing in the lending data, and how a crackdown could completely reshape the entire market heading into 2026. It's linked on screen and in the description box down below. Check it out right after this. So guys, with all of that said, as we move into 2026, the message from the data is very clear. The market is tightening, momentum is broadening, and several capital cities are now moving in sync for the first time in years. And that combination, it doesn't happen often. And when it does, it usually marks the start of something much bigger, and not just a random spike. But remember, a boom isn't the destination, it's just the environment. And the environment only rewards you if you're disciplined in the choices that you make. Because at the end of the day, anyone can ride a rising tide for 6 to 12 months, but only the people who focus on the fundamentals, land, location, scarcity, long-term demand, get rewarded years after the cycle cools. The funny thing about rising markets is that it makes everyone feel like a genius, but the market eventually sorts out those who were strategic and those who were just lucky. And the gap between those two groups becomes more and more obvious the moment conditions tighten again. So if you're entering the market, upgrading, investing, whatever it is, do it with intention, with clarity, with data. That's how you build something resilient, not just something that rides the wave and falls flat later on. With that said, guys, I really appreciate you making it right until the very end of the video. And if you got value out of it, make sure you hit the like button, subscribe so you can continue receiving updates just like this in the near future. And with that said, I'll see you in the next one.